Pre- Presenting our panelists for our last session of the day through the eyes of a VC. Over to you, Mr. Sahil, to take forward this conversation. Looking forward for a very insightful discussion.
Yeah, pleasure is mine and glad to be sharing stage with some of the most renowned faces of the ecosystem, as well as my ex-boss, Nitish. So maybe starting with VTU, given you have been a part of the ecosystem since late 2000s, 11 years at Sequoia, how do you think at least till 2015, the ecosystem has evolved from a investor perspective, at least India becoming a market which can't be ignored, as well as the founder mindset. Say, when I graduated, at least I saw in 2012, few of my batchmates at least talking about entrepreneurship. So just from your eyes, that time, how did it look?
Yeah, no, I think it has evolved a lot, and I think when you think about it for a panel discussion like this, you suddenly realize how much things have changed. So I think the big change, and I joined investing in 2007. It was still a relatively early ecosystem, and capital was coming to India, but mostly for the private equity style investment. Even then, private investing itself is a very, very new industry, and I keep reminding people that when people point fingers and talk about the mistakes being made by the ecosystem, that net it's a very, very young industry. It's a less than 15-year-old industry in India. Uh, and it's kind of grown in fits and starts in terms of both the amount of capital available, the amount of talent available, and also in terms of just the nature of opportunities which people are trying to kind of focus and build companies on, and all of that has changed. I would say the starkest and the biggest change is in the type of the entrepreneur who is now starting the business, and that was very different in India of 2007 to 2010, and I would say 2011 is when at Sequoia we started investing a lot more in younger and earlier stage companies. And the profile of the founder, right, which is first generation founder with sometimes without experience, it could be fresh out of a college, sometimes with meaningful experience, it could be 10, 20 years. Um, and I think something has changed because of which over the last 12 years, as I see it, you are seeing a lot of first generation founders. And just to give you the magnitude of that, I would say, we raised our first fund in 2019, and that fund has 14 companies, and 13 out of the 14 are first generation founders, right? And the numbers are staggering. The extent in which the pendulum has shifted away from, let's say, capital going to a existing promoter group company or a promoter company, or something like that. It's completely changed, and that is the first and the most profound change, because I think what that is allowing uh, those founders to do is to kind of build businesses very differently from, let's say, how the older generation business families would have built businesses. And I always think of it as the modernization of Indian capitalism is a very abstract way of putting it. But that is what is you see starting to happen in 2011. I think that trend has only become firmer and stronger, because that trend has gotten supported by two things. One is willingness of talent to work for young companies, and willingness of talent to consider young companies at a relatively earlier stages in their life. Someone earlier, if you were joining a wonderful company like Unilever, would say, there are always going to be people, and there have to be people who will build those large companies and take them to bigger places. But you're seeing a reasonable cohort of high quality people who spend 10, 15, 20 years saying, hey, you know what? I've done this. It's exciting, but I want more excitement in my life. I want to do something different. I want to leave a mark on the company that I've been a part of. So one is a founder saying, I want to leave a mark in the country that I have been in, and then there's a talent which is saying, I want to leave a mark on in my life and career. I want to be able to say I was a part of something that got built. So the talent, I think, has learned to embrace younger companies much more, profoundly more, over the last 10, 15 years than it ever was, in 2011 and 2007, especially when I started investing. The third has been the availability of capital. Look, and capital is going to come in. India has always attracted more capital than I've always believed. India has attracted more capital than it ever deserved at any point of time. People were investing in India in 2007 thinking that it's a 2,000 per capita income country when it had a $700 per capita. And today people invest thinking it's a $5,000 per capita company with 2,000. But I think that is because there's a lot of wonderful, linkages between US institutions, which are largely responsible for building the private investing business in India and Indians and India. So there's a lot of connect, a lot of trust, and the capital is always flowed, sometimes a bit ahead. and capital by its very nature, flows in fits and starts. But the good news is that capital has been available. So I think these are the three, I would say, forces at work. Capital being available, openness of really smart talent to join companies, and founders with varying backgrounds. It's not the American style startup is a bit different, and the Indian style startup could be a 50-year-old who has spent 20 years in insurance and says, I want to build an insurance company. It could be a 40-year-old who says, I've spent 20 years in pharma, I want to build a pharma company. It could also be the 25-year-old who says, let me go and build something on consumer internet. So the Indian startup entrepreneur is a bit different. He's sometimes, on an average, on median, is actually older. In median, he's chasing a much wider menu of opportunities because India is early in the development cycle. And those are big forces at work, which is what make our job quite exciting.
Yeah, that's pretty interesting, VT. Especially you forget how it looked when the industry in fact started, and say a 50 million or 100 million was a very big fund to be in the market at that point in time. So taking cue from there, maybe Nilesh, you are also an entrepreneur, started in 2015. How have you seen, like, from educating entrepreneurs, what venture debt is? How has the quality of founders changed in at least 2015 to pre-COVID, as well as what impacts, say, acquisitions like Flipkart had on the entrepreneur as well as the investing world, seeing from a global perspective?
Thanks, Sahil. VT made some very interesting points. I think, we're seeing a very different breed of founders. Sometimes we are seeing serial entrepreneurs. Yeah, one of the least celebrated, founders in this country is a guy called Super Maheshwari, who built First Cry, and then he built Express Bees, and then now he's building Global Bees, 3 unicorns. All offshoots of the same business. We're seeing founders now coming from very small cities. I recently met a founder who grew up in a village in Rajasthan, is now building something in the rural ecosystem, and probably one of the most talked about, startups. We're seeing now founders, in fact, a couple of Bitsians who are building a very exciting startup in Indore. So, one, we're seeing this momentum of entrepreneurship practically in every major city and every small city in the country. Two, I think last 7 years have been extremely volatile. We had many disruptions thanks to demonetization, GST. We're seeing a startup funding winter. We saw one in 2016. So for people like VT and I, we've seen these cycles, and we don't, we know it just plays out. There's always growth, and then there's always, focus on profits, and then growth and profits. But I think these last 7 years, as investors, we've also grown significantly. Founders have grown, but we've also grown significantly, and just being able to guide, mentor, and coach the next founder as to situation like this, what needs to be done, because we've done it before. So I think that is the other very interesting thing that we are seeing. In terms of an ecosystem, we've come a long way. We just celebrated the 102nd unicorn yesterday. The 101st was a company that actually I had not heard of until 1.5 years ago. It's a 2-year-old company called PhysicsWallah, that became a unicorn and just came out of nowhere. So you're seeing we think everything has been built out in tech, and then there's still another company that can come and disrupt and build something very unique and create a lot of value for for investors, and also create a lot of educational outcomes, if you will. So I think the pace of innovation has only exacerbated. The amount of capital that is currently sitting dry powder, as we call it, I don't think we've had so much dry powder. I think VT is sitting on $500 billion. We're sitting on $500 million at Trifecta Capital, and so is Akarsh at Elevation. They raised their largest fund. So just three VCs here have about $500 million. So we've never had so much money to back the best founders. But just coming back to the question of venture debt, which is something we had identified as a gap 7 years ago. We've come a long way. It's now an industry. 7 years ago, very few people had heard of venture debt. It was hard explaining to them what it means, why it is useful, why it is important. And I think we've Trifecta Capital. We now have $1 billion of capital available to be given away as venture debt. So that's massive. We've been doing 35 $40 million venture debt transaction to single companies. So it has come a long way. There are a few other venture debt firms, and we are also seeing interesting use cases from 7 years ago it was runway extension, to then it became for working capital, for capex. And in the last 15 transactions that we've been involved with, at least half of them have been for acquisitions. So it's and that brings me to the very interesting point you talked about, is acquisitions and how they are playing out in the ecosystem. I mean, clearly we didn't have large companies, until a few years ago, that there could have been any meaningful acquisition. I mean, most of the time we heard acqui-hires, and that's what we saw in the first 3-4 years since we started. But we're now seeing massive acquisitions. You look at what Byju's has done, created a very, very large business, been very acquisitive, ever since. Good Lamb, a very exciting company in beauty cosmetics, has been acquiring a lot of companies. And I think there is, linked to the growth of the startup ecosystem. One, we have seen large companies. We are also now seeing a lot more ambitious founders with much larger vision than we saw 3-4 years ago. I think that has been one big change that I have personally seen. The founders are now thinking very big, and that they obviously have large balance sheets. They have large businesses that they can do. But for any VC ecosystem to have meaningful impact and create wealth, I think M&A is a very integral part of the growth of that ecosystem. In the US, 70% of exits happen via M&A. In India, that was always a big problem. Now, we saw two things last year, which is fundamental and very structural. One, we not only allowed loss-making companies, startups to list, through regulatory changes, but we also now have about 102 unicorns, which have the power to be acquisitive. We have the Amazons, the Flipkarts, the Reliances, the Adanis, the Birlas, the Tatas, who are all now looking to add exciting startups to their portfolio to grow. So I think overall, the ecosystem is growing beautifully. The US, I think, is 75 years and about $165 billion of capital being invested in a normal year. Forget about last year. India is about $10 to $20 billion. So we're still a very small, young and maturing ecosystem, but I think we've come a long way in just 7 years. So sorry, it was a long answer, but I think there were aspects that I just wanted to cover off.
Right. No, Nilesh, that was right, spot on. And the Flipkart exit, $18 billion back in 2018, and the secondary starting, and then even the Byju's getting bigger, giving $1 billion kind of exits were definitely a needle mover in breeding new age entrepreneurs, because it's a virtuous cycle. And investors also now feeling there is a path at the end of the tunnel also to get an exit. Taking a cue from there, Akash, maybe what has been your journey, especially in the last 4 years? These were years where the horizontal e-commerce and edtech, fintech were largely set, but there was then flushing of new kind of spaces. Bunch of them you have delved deeper into, and then COVID hitting the final kind of nail in the head by expanding the market maybe 10 years ahead in 2 year time frame. So would love to hear your journey. What kind of entrepreneur did you see from your lens over the last 4 years, and the spaces which you have explored at Elevation?
Yeah. Thanks, Sahil, and a pleasure to be here. A privilege to be here, essentially. So, last 4 years, I've spent my time across consumer tech, B2B, both commerce and SaaS. Obviously, Elevation is a sector agnostic sort of a fund, so seen quite a few new sectors coming in. I think one thing that I have learned essentially in the past 4 years is that I don't think any sector is dead at any point. 2016, 2015, 16, everyone thought that e-commerce is done. We have the two largest players, and then Meesho came out of nowhere, and then Meesho scaled really well. Same thing happened at food delivery in 2014, 15, when there were a bunch of players who sort of had raised a lot of capital, and then there were two new companies. Zomato had been around, but they were just starting with delivery, and then Swiggy was there. Again, sort of scaled really well, and those are the two surviving food delivery companies today. So that's one learning. I think there are enough access to sort of be able to create a business in any sector that you start with. And obviously, TAM, etc., are a question in a few of those. But I don't think horizontal where the marketplaces of fintech opportunities are dead in any way. That's one. I think the second big change, the second big sort of theme that I've seen emerging over the past couple of years is that Indian founders sort of thinking global from the get-go. This is truer, and this has evolved because I think partially because of a lot of large companies being in the B2C space, founders have started to focus on the B2B side where you're not as constrained by borders. And there, both whether you think about B2B commerce or you think about SaaS, founders are starting to think global first right from the get-go. Obviously, Freshworks success, and then B2B sort of commerce taking up companies like Zetwork, etc., Zetwork, Market, finding capital and scaling again transactions and showing that there are enough margins in that value chain to be captured. I think were sort of created those cycles. Third, obviously, the new sectors that have emerged. I wouldn't call SaaS new. It's been around for now almost. India SaaS story is now almost a decade old. But the new sectors, whether you think about crypto, Web3, etc., again, are essentially without borders. So from get-go, again, you start thinking about a global product. You have to acquire customers globally. You have to build a product which can stand, let's say, the product which is as efficient as, created by a developer sitting in Ukraine or somewhere in Eastern Europe. And from the design standpoint, is as good as something created in the US. So I think that is a third big change I have seen. On COVID, I think there were, again, 2-3 major changes in my mind. One, in the initial phases of COVID, when no one knew how the capital cycle would play out, and everyone thought that the funding winter is here. Actually, in a lot of our portfolio companies, we saw profitability accelerate. People cut down on a lot of spends, and in a few of our companies, we saw them turning profitable, essentially. But then, obviously, what happened on the other side was that because of everything becoming remote, there was virtually no friction to sort of fund a company. Earlier, you would go offline, do a diligence, etc., and now those discussions were happening on Zoom. So that shortened the capital raising cycles. And because of the loose monetary policies, a lot of capital was available. Several global investors starting investing in India. Because a hedge fund sort of became active, and then a lot of capital was available. So because of that, that journey of profitability, I think, to a certain degree, stopped at that point, and companies raised a lot of money ahead of the curve. And now I think sort of the pendulum seems to be swinging back. Let's see where it goes. So that's the thing. I think digital adoption obviously accelerated quite a bit. For B2B companies, it was a boon because whether I think of SaaS, whether I think of commerce, they realized that, the commerce companies realized that an organized company in an otherwise unorganized market probably is able to hold you better and hold supply chains better when such disruptions happen. Second, for SaaS companies, the earlier requirement of having, let's say, a footprint in the US sort of to a certain degree attenuated. So their companies were okay to adopt these tools and accepting these tools, accepting the salesperson remotely, right? And again, this is something that has not gone back even after the market opening up. So that has given us a leg up. Essentially, it has shortened our GTM cycles essentially on the SaaS side. These were the 3-4 things in my mind. I think we saw in COVID.
Yeah, I think totally spot on. I think at India Quotient also we backed SMB SaaS, and where the thesis was the same. Okay, global lack of global footprint was not even fundable at all, right? But I also see companies in the portfolio scaling up to 10 to 20 million ARR very easily. But going back to the pendulum thing, I think what gave us a lot of smiles, maybe initially when the funding was on gung ho mode, entrepreneurs thought profitability should be achieved and going on the other side of the pendulum. And now they very soon we are, some people are saying this second winters and international VCs coming up with burn rates and all. So VT, you have been on the forefront in this growth versus profitability debate. Although the TAM has expanded, right? When say India Quotient portfolio share Chat Sugar are funded, not even 10 million paying users were not even the TAM. Now at least it's the debate is whether it's 30 million or 15 million, right? So, but how do you think the mindset has changed, and what's the way forward, given what we have seen in the listed IPO space and bunch of funding, investors being taking a backseat for a while?
So I think there are two parts to this. I think one is for the audience, which is, if you're a young person thinking about building your own company, what does it mean for you? And then there is a bunch of things for us, as we think about and have these conversations, right? uh, I think there are two parts to it. One is every winter is different, so we don't know how this is, how long it is going to be, and those are all driven by macro factors, which honestly, even economists keep doing one hand and the other hand, right? So very hard to have a view saying what does this look like. That is one. So I always tell people when they ask, I said, look, every winter is different. You try to draw parallels from other winters, saying, look, as they say, right, if winter is here, spring can't be far behind, but we just don't know how far and when it is coming. The second point I always say is, look, the message for every company in terms of what they need to do is different. So I almost I would eschew reading broad messages and say this is what is applicable for every company in every place. It makes no sense. If you're a founder who has product market fit, who's just raised capital, you can't sit and say tomorrow, how do I make sure that my 36-month or 48-month runway becomes 10 years? It just makes no sense, right? This may be you've gotten lucky, you've raised money at the right time, you're sitting on good product market fit. This may be the time to accelerate, right? Versus say, let me cut a few jobs and let me fight. I think the answer for every founder will be different, and there is nuance which is required. And I would say the learning from the last two winters, and this is the maturing of the ecosystem that Nilesh spoke about, is I don't think we are reacting to it the way we reacted, for me personally, 2008, or how I reacted in 2016, because I keep telling my founder, don't read any decks. The message for each one of you is different. You are all in very different places. And therefore, first, there is a reality check saying your availability of capital is harder. It may take longer. If that's the message, what do you need to do? And the answer for each one of you may be very different. Depending on where you are on product market fit, depending on how much runway you have, and depending on your competitor dynamics. Because one of the great advantages of lack of funding is that if you're ahead of the curve, you can really press and grow the distance between you and competition. So then you'll be foolish to kind of put all brake slam and say, let me just make sure my runway goes from 4 years to 10 years. It will make no sense. So the second message is nuance. And third is, for the young founders who are trying to be founders, look, this really is of zero relevance. This is literally like the global macro story. You can read, these are intelligent debates to be had. But if you're a founder who really has an idea and wants to start, just go ahead and start. Because the broad environment saying there is an angel ecosystem, there is a Series A ecosystem, there is now a larger ecosystem which exists to kind of shepherd you along, exists, capital is available, and therefore go and build what you want to build, if that's what you want to do. And leave it to these panels to, have conversations on, length and depth and, meaning of the winter. At least that's my, that's my reaction, which I have at least. I don't know whether I don't have anything more to add.
Right. Nilesh, it would be great to hear your perspective as well. Like, how has your evaluation parameters changed? What would you advise, say, somebody in BIT's fourth year while envisioning right? Like we look up to, say, Sanjeev Bikhchandani and all who really have made free cash flow positive companies. How should they envision, and how has your evaluation framework kind of evolved, at least at current point of time?
Yeah, so I personally think, this momentum of the Indian startup ecosystem is unstoppable. Uh, and this is perhaps the best time to start a business. I mean, just imagine when Sachin and Binny were building Flipkart. There was no logistics, there were no payment gateways, there was no trust in e-commerce. So I think they've done the hard work of actually helping build a very large ecosystem on the back of which many businesses can be built. So actually, it is half the effort to build a business today. Um, and so this probably is the best time, but that said, any time is a good time. And in India, it is a land of opportunities. It's you got younger generation. Just imagine. I was just talking to some Japanese friends, and they were telling about their aging population and why they find it very difficult to adapt to some of these technologies that we are consuming on a regular basis. So we are a young country. Hopefully, we are the only shining light in the global, stage, because we are growing and we expect it to grow. Uh, so I would just encourage everybody to, if they want to be an entrepreneur, they should. As it relates to the funding winter, I just think these are cycles. Uh, and this is normal. I mean, you go to a wedding, you eat a lot, and then you say, I'm going to, diet for a few days and get back to shape. And I think that's very much imminent in the startup ecosystem. Uh, globally, governments reacted to infusing liquidity to solve for the COVID issues. That liquidity translated into private markets. A lot of it came to India, and clearly that was not meant to be permanent. So if anybody was thinking this is going to go on forever, I think was clearly mistaken. So a lot of us were already anticipating this, and I think in some sense, this winter, as we call it, and I'm always a optimist. So I do think spring is round the corner and will come when it is due. But this is time for all founders to fix their businesses, to get rid of the noise, to rationalize, because at the pace at which some of them have been growing, you didn't spend a lot of time. You were still, the leadership was still settling down. The KRAs were still, being developed, and so on and so forth. So I think this is a perfect time to sit back, and we've seen many cycles of this. And the good news is that Indian founders are very receptive, and they're getting excellent advice from VCs saying, "Listen, you need to fix this soon, and just be prepared for the worst case scenario, which could be 2 years, elongated winter." But when you do that, you just end up building stronger and stronger and stronger businesses. I think also, what is happening in the tech companies listed in the stock markets. I think that's also giving good signals to founders and investors, saying, "Listen, long term, this is what is going to work." And so you need to be focused on bottom line. So I think there are two things that have happened. One is this talks of a funding winter, and two is how public markets have behaved and how they have treated different tech companies differently. I think is also an indication of what to expect as you build a business. So I think this is all founders who are cutting costs, and I do feel that it has to be done empathetically. It has to be done in a way that the pain is low, but you have to fix it, for the better good.
Right, right. And uh, Wonderful points raised there. And Akash, maybe you can chip in. What are you advising, maybe your portfolio companies at this point of time? And again, more importantly, say what would you advise these young bits folks, just like your classmates of IIT Delhi, Dom? Like we had zero clue at our point of time. Maybe my roommate went to Flipkart and ended up creating later Rapido, right? I had zero idea that he would do that while playing with him in the undergrad days. So I think your views at both of these points on the current winter scenario, and then on advice to this young audience here on how to select ideas and maybe what to jump on would be very helpful.
Yeah. Um, this is my first winter, so I'm just sort of trying to learn and see, and not trying to predict anything. I think just to add to what VT and Nilesh said, I think nuance is probably the most important thing. I think even in our portfolio, and we have a large portfolio, we see companies of all shapes and sizes with at various stages of their uh, um, uh, funding life cycles, varying stages of sort of cash left in the bank or runway, and for each of them the advice is different. Um, I think a couple of things apart from the funding winter that have changed. I think, and one of these has sort of been around for some time now, with the life sort of returning back to normalcy. At least it seems with COVID, and with that, the implications on customer acquisition, the transaction sort of friction that is there. I think that's one thing that it will change, and we are seeing sort of evidence of sort of some change, essentially, the implication in sort of customer acquisition costs, etc. We are seeing. I think that's another thing apart from the funding winter that we are seeing. Otherwise, I think the advice is pretty consistent, right? If you have money in the bank, and if you have PMF, try and scale, right? But probably scale in a manner which is uh, less, I would say, momentum, but more sort of sticky and more sort of cohort driven rather than, let's say, volume driven, if I would say. Um, Second, if you are, let's say, in a place wherein you have 12 months of runway, you should try and go out and raise, essentially. If you can't extend that 12 to 24, there is a survival risk there, right? If you are anywhere in between, I think then the answer becomes a lot more nuanced there, and you then spend time essentially figuring out what the best thing is. For the early stage founders, I don't think anything changes in my mind. Um, there is enough capital within the Indian VC ecosystem to support early stage companies across. Um, we are early stage investors, seed series investors. It's not that our sort of the way we evaluate companies has specifically changed in seed or series A. Uh, I think if you think about at these stages, right, seed, series A, essentially, there is enough upside to be captured. I don't think any VC would particularly be concerned about a funding cycle there. Um, so my sense is if the founder today is sort of very confident about the idea, they are very clear they want to do entrepreneurship, and they want to do entrepreneurship not to raise rounds but to sort of create value, then they should start right away. That's what my sort of 2 cents would be. What they should not expect is that, okay, in the past 3-4 years at least, we have seen that companies becoming unicorns and raising large rounds at sort of low revenues or with limited proof points, and those journeys becoming shorter. I think what they should be prepared sort of mentally would be more sort of extended periods of uncertainty, essentially. But that, I think, comes with being a founder. So for early stage founders, if you're confident and you want to create value, just go ahead and start.
Yeah, I think that I also have personally seen at least the kind of pre-seed to seed ecosystem, the initial couple of crores of capital has been solved by the angels, right? That's a very big positive in the ecosystem. Like when share chat rate, the first raise was hardly 50 lakh. And so I think that's a beautiful part of the ecosystem. But again, VT, moving back to you, what would you advise, like given capital is there, right? You are getting capital to experiment, but I've seen like bunch of pitches that I receive. They go, most of them would have seen this problems in the edtech space, or very consumer basic ideas, which might not be very fundable per se. So, what would you advise, say, if you're to these young bits audience, while choosing the spaces they choose to devote a decade of their time?
Yeah. So look, I think uh, only two things I have to say, especially for young founders, right? Obviously, you have to find a space in which you have some interest, a natural passion, because founder journeys are long. While the optics around it, the optics of becoming a unicorn, and media will have you believe that these things happen in 2 3 years. The reality is that for most people, any semblance of success which is recognized by the world could be anywhere between 10 and 15 years, right? So if you're going to do that for such a long time, you jolly well at least need to enjoy it and enjoy the process. Second is, I always tell young founders, money cannot buy you product market fit. Money can buy many things in the world. It can buy you scale. It can help you accelerate. It can help you get talent. But money can't give you PMF. For PMF, in fact, we have seen again and again and again that the time it takes to get the product market fit. Some people are lucky; it may be 1 2 years. Sometimes it may be 3 years. That is not solved by capital. So spend the time in getting product market fit, understanding what it really means, and you know it when you see it. Eventually when you try, the fact that a consumer is adopting easily, the sales cycle is becoming easy, whether it's a consumer product being B2C or whether it's a B2B product, you can sense it as a founder, and we try to sense it as investors, right? Saying, hey, PMF hai ki nahi hai, you can get a sense, right? So I think keep your eyes and ears open for that, and that's what I would advise young founders. For the older founders and that not right cohort, I think the trick to learn, whether you're a unicorn or whether you need to raise capital is, a bit of what Nilesh and Akash said, which is, look, you have to look at the public market companies, right? And what do they do? When they need money, they raise the money. They don't bother saying, my valuation last year was so much. Bajaj Finance QIP almost failed in 2008, right? I'm saying that's the irony of capital markets and when you need to raise money, right? So, forget about, so I think one of the things and I think that's a part of the maturing of the ecosystem, which is you have to start behaving like a bit like how public market companies behave, which is if you feel you need money, you raise money. You don't care about what it takes. You just make sure you do it because you have to live, to survive and thrive, when things become normal. I think that is something to learn. The second thing to learn from public markets, right? I'm saying, look at the top 20 public market companies in India in 1995. I think barely one of them will exist today. So unicorns will churn. That's the nature of capitalism. That's the nature of the Schumpeterish element, right? You'll have 100 unicorns. Some will die. Some will grow. Media will talk about those that grow in good times. Media will talk about those that crash in bad times. Ignore all that noise because that's the very nature of what we are signing up for. That would be it. Yeah, that would be my 2 bits.
Yeah, great inputs. So, Nilesh, what would your advice be, and how do you see the ecosystem evolving on both sides, say, over the next decade?
I think there are opportunities everywhere, and I quoted about an edtech company where we thought everything had been done, and it was just hard to build another edtech business, and it got built. So I think there is opportunity everywhere, whether it is education, healthcare, logistics, transportation, food security. Uh, there is opportunity just everywhere because India has a vast population, young population, but broken infrastructure. And so, if you really see, we have a lot of tech-enabled businesses, but I think we're beginning to see some green shoots of very exciting deep tech companies. And I would, while VCs also have to train themselves on being able to evaluate companies such as this, I think there are enormous opportunities in just building cutting edge, tech and deep tech companies, whether it is in the area of neural sciences or what have you. I mean, we do have, amongst the brightest, talented people in this country. So there's no reason, and they are the people who are doing all the innovation in the US anyway. I do think, also that, one should generally, look at the competitive landscape, focus on the TAM. I think that's very important. Is how large is the market opportunity? Because you want to go after large market opportunities. VCs want you to go after large market opportunities. So, focusing on the TAM, focusing on the competitive intensity, focusing on regulatory environment are some of the things that will help you, identify areas that you want to get involved in. We are seeing, tremendous amount of investments being done, being made, and are likely to be made over the next 20, 30, 40 years in clean tech, in renewable energy. I mean, that's an area of opportunity. And we've been scanning the market for the last 2 years. Unfortunately, I've not been able to find an interesting asset to invest in, just because perhaps many times we felt it was technology that was still evolving or could easily be disrupted, and that we did not have any great IP over it. But I think there is a lot of work that's happening on the clean tech side. We are getting a lot of inbound requests from our investors saying, what are you doing about ESG as an example? So I think global allocators of capital now are beginning to focus on ESG. So that presents very interesting opportunities, and there's a pool of capital that is waiting to go into ESG opportunities. So there's just so much opportunity in India, because we're still a developing country with significant I would say people who are below the poverty line, which have very low access to healthcare, which have low access to education, and so on and so forth. So the opportunities are just enormous. I think most funds in India remain sector agnostic, and there's enough capital. So to the founders who come with interesting ideas, who show passion, deep interest, and able to convince us that this is a large business to be made, I'm sure we will be open. But like VT very clearly said, I think anything that one decides to do should be driven out of passion, out of some interest, because this is a very, very long journey, and it can get very lonely at times. So it's sexy to be an entrepreneur, but it's a difficult job to sustain it. That said, from a bits perspective, somebody mentioned bits mafia. I think I believe about 20% of the startup ecosystem is touched by Bits Pilani. It's a very powerful ecosystem. And for Bitsians who want to be entrepreneurs, there are just incredible investors out there to help mentor. There are great founders, Swiggy, MPL, Grow. These are all Bitsian companies. Zeta, just lots of knowledge there. People who have built very, very large businesses, people who have been building businesses over the last 15 years, have seen many, many winters, have seen many summers. So I think there's a wealth of knowledge, and in that ecosystem, one should leverage, and one should get a lot of guidance, and then decide if what they want to do is the right thing to do.
Right. Maybe the leveraging the ecosystem is the right word. And maybe given we are on the fag end of this session and taking a question from the audience, like open to the panel, have you seen any correlation in the quantum of capital available to the quality of ideas? Does it increase? Is it the other way around, or totally uncorrelated? And any other parting thoughts open to the panel here? Yeah.
Quantum of capital to the quality of ideas. See, I think again, at least the decision making, the way it works in our case is first, instead of the valuation or instead of the quantum, I think the first decision is whether to invest in the idea or not. So quality of idea takes precedence, quality of team takes precedence over the quantum question or the valuation question. And in most such cases, in the early stages, I think the quantum is based on what the founder needs and what the founder feels they need, essentially, to, let's say, for a 12, 18, 24, 36, whichever stage they are in, right, depending on the stage, what kind of runway they are looking at, and what kind of ownership, essentially, the VC needs. And then there are some ambiguous valuation frameworks. I don't think there is a way to value, essentially, specifically. So, yes, definitely, I think quality of idea is paramount along with the quality of team. Quantum probably comes secondary.
great thoughts there. Yeah, a bunch of takeaways. The ecosystem has really matured, and there is no dearth of at least the early stage capital here. Both early stage and late stage founders had their fair bit of learning. But again, it's a very positive outlook going forward. So maybe I'll end it here and request the BITS organizing team to take it from here. And it was a pleasure talking to VT, Nilesh, and Akarsh on this fantastic session. Yeah,
Thank you.
Thank you for the lovely moderation, Sahil, and always a pleasure to be on BITS events.
Thank
yeah,
you.
pleasure is mine. Yeah, thanks.
Thank you to all our speakers. And the panel discussion gave us valuable insights into how VC evaluates a startup, what they look at, and how they decide to invest in startups. All four of our panelists are experts in the VC space, and their years of experience was beautifully summarized in this panel discussion. Thank you so much for joining us, Mr. Nilesh, Mr. VT, and Mr. Sahil.
Before we end the first day for the India Portfolio Summit, I would like to add a bit more about Conquest. At Conquest, we are focused on helping early stage and pre-seed startups gain a strong footing in the startup ecosystem through our accelerator program. Over the past 3 years alone, we have catered to 5,500 startups while offering a wealth of resources and networking opportunities. Our accelerator program has 3 key pillars. Number 1, our online mentorship sessions with industry stalwarts, covering all the key elements of growing a startup from 0 to 100. Number 2, our network of investment partners. For this year's edition, it includes Westbridge Capital, 100x VC, Nexus Partners, Bessemer Venture Partners, Rain Matter Capital, and many more. Our third pillar is our resources, worth $100,000 plus for this year's edition, along with our equity less cash prize for our winning startups, which was set at a combined pool of 60 lakhs over the past 2 years.
The grand finale of our accelerator program is set in Bangalore and comprises of the top 10 startups in our cohort moving to Bangalore for a 7-day accelerator program, which provides co-working and co-living space. The finale provides a stage to pitch in front of various stakeholders in the system, investors, industry leaders, media houses, and jury members, with our equity-less grant up for grabs. Registration for Conquest are open till the 14th of June. To register, head over to our website conquest.org.in and click on the register button. I repeat, to register, head over to our website conquest.org.in and click the register button.
This brings us to the end of the first day of the India Portfolio Summit. We would once again like to thank our guests for their enlightening words and our audience for joining us today. The summit will resume tomorrow at 2 p.m. with an Ask Me Anything session on the marketplace model with Amit Kumar Agarwal, founder and CEO of No Broker. Tomorrow's schedule is packed with industry stalwarts such as Adit Palicha, co-founder and CEO at Zepto, Manish Pandey from Josh Talks, Harsh Jain, co-founder and CEO of Grow, Vibhor Jain, COO ONDC, and many others.
We hope to see you again tomorrow. Till then, on behalf of Team Conquest, have a good night.